In trading and investing, technical analysis is one of the most effective strategies for simplifying large amounts of data in order to ease the decision-making process. Technical analysis is a skill that takes years to learn, apply, and refine, and if it's applied properly, can certainly improve your results as a trader. There are literally hundreds of technical trading rules, each with various applications on the marketplace. In today's video, we'll take a look at 10 of the most important rules. Number 1. Master support and resistance. Support and resistance are the most important components of technical trading. Support areas are prices where buyers tend to overpower sellers, whereas resistance areas are prices where sellers tend to overpower buyers. These price levels allow traders to evaluate the potential risk and reward of a trade. The key is to be able to measure them properly. First, we have static price points. A static price point can be any number where price has historically shown support or resistance. Then we have psychological price points, which are similar to static price points except they don't require any historical confirmation. For example, a stock trading at $98 may run into resistance at the price of $100 due to the psychology surrounding the change in price. Then we have trend line touches. A trend line is an imaginary line that is drawn to illustrate a trend. Trend lines are drawn by connecting the highs or lows of the price with straight lines. These lines can be used as support and resistance levels. And finally, we have technical indicators. Certain overlay technical indicators can also be used as support and resistance. These indicators can reveal significant price points that otherwise wouldn't be visible on a chart. For example, a stock may use its 200-day moving average as support or resistance. Number 2. Understand the trend. A trend is the general direction in which the price is moving. The trend can go upwards, downwards, or flat. Understanding a trend helps ensure you are on the right side of a trade. For example, if price is in a downtrend, it wouldn't be wise to initiate a long position unless there are clear signs of a trend reversal. It's also important to account for timeframes when analyzing trends. A stock, for example, can have different trends across different timeframes, and you need to pay attention to the trends that are most relevant to your trading style. For example, a stock may be in a year-long uptrend, making for a nice investment opportunity. The same stock may be in a multi-day downtrend, making for a bad long biased swing trade or for a good short opportunity. Third rule is to find a balance between anticipation and confirmation. When planning a trade, there are two basic approaches. You can anticipate a move, or you can wait for confirmation. Both methods have their pros and cons. Anticipation can provide better entries with less certainty, whereas waiting for confirmation provides higher certainty at the expense of a later entry. Let's use an example to illustrate the concept. A stock is trading at a price of $9.50 with a 52-week high of $10. If you anticipate a breakout, you could enter at the price of $9.50. If you wait for confirmation, you would have to enter at a price above $10. So which is better? Unfortunately, there's no definitive answer. As mentioned, there's a trade-off between the two strategies. If the stock has support at the price of $9.30, for example, it may make sense to anticipate the move. If the stock has support at $8, you may want to wait for confirmation. Number 4. Use different timeframes on your charts. Trading activity includes day traders, swing traders, investors, institutions, scalpers, and more. All of these different groups rely on different analytical tools. That's why it's important to focus on the bigger picture. One of the ways you can do this is by analyzing charts across multiple timeframes. Pay attention to intraday charts, hourly charts, daily charts. This can help you to identify significant price points and get a better understanding of the mentalities of other traders. For example, a price of $5.20 may not be a significant price on an intraday chart, whereas it may have major significance on a daily chart. So analyze multiple charts and try to understand the perspectives of different types of traders. Number 5. Use trading volume to understand price activity. Every trader is focused on price. In fact, most of us obsess about it. But it's important to follow the volume as well, especially if you trade stocks. Not only does volume increase liquidity, which is the ease with which you can buy or sell, but it also shows you the true interest in a stock. High volume reflects high interest in a stock, making for better trading action. Trading volume also serves as a warning as to whether a stock is on the verge of breaking into upside territory with high volume or into a downside trend with low volume. High volume also gives investors more time to determine when it's the right time to sell for a profit. A dramatic rise in volume reflects the increased interest and sustained momentum. Number 6. Find confluence in trading entries and exits. In trading, the presence of confluence refers to a circumstance where multiple technical analysis factors collectively form the same indication. Since multiple factors are combined, confluence has the potential to greatly increase the reliability and accuracy of trades. That's why confluence is the most important probability enhancer in trading. Popular examples of confluence are a point where a broken resistance, now acting as support, aligns with a support trend line, a point where a support level meets a Fibonacci retracement level, a point where a dynamic form of support, like a moving average support, aligns with a static support, for example an horizontal level, or a point where an oscillator like the RSI gives a strong signal at a level which also acts like a support, for example a bullish divergence at an horizontal support level. Now, very important, when applying the concept of confluence, strongly correlated factors cannot be combined. For example, indicators that measure something similar, the RSI, the money flow index, or the stochastic, cannot be combined to establish confluence, since they are all oscillators. An oscillator could be combined with other technical analysis factors, like horizontal support for example, but combining a bunch of oscillators or other strongly correlated factors will not enhance reliability. Number 7. Always analyze wavelength and steepness. The length of the individual trend waves is the most important factor for assessing the strength of a price movement. During an upward trend, long rising trend waves that are not interrupted by correction waves show that buyers have the majority. On the other hand, smaller trend waves show that the trend is not strong or losing its strength. The rate with which the price rises during a trend is also of great importance. In general terms, moderate trends have a longer lifespan, and a sudden increase in price usually indicates a less sustainable trend. We can often observe this phenomenon during so-called price bubbles, wherein the price falls again just as quickly after an explosive rise. The development of the steepness of trends and price waves compared to the overall chart context is also important. Accelerating or weakening price waves might show that the trend is picking up speed or is slowly coming to a standstill. Interesting correlations can be made together with the concept of length. A trend is intact if we find long trend waves or trend waves that become longer with a moderate or increasing angle. A trend with trend waves that become increasingly shorter or which is simultaneously losing its steepness indicates a possible imminent end. Number 8. Use wider stop losses and reduce your position size. You have a tool on your side to assist you in giving trades the time that they require to turn into big winners. That tool is the stop loss placement, and more specifically, considering the use of wider stop losses. Giving a trade even another 50 pips, for example, can significantly improve the chances of that trade flipping from a loser to a winner. The reason is that many trades are taken or should be taken at levels of support or resistance, perhaps after a pullback with the trend. However, we cannot predict exactly how far a market will retrace, so giving that trade more room near that pullback area can many times avoid a stop out. Remember, wider stops will keep us in the game longer and improve our chances of success over a series of trades. Number 9. Pay attention to imperfections in price patterns. Price, being a dynamic concept, can't be 100% reliable. There will be certain imperfect price actions that will not conform to your textbook ideas and rules, so don't try to force those patterns on the market. The reality is that we try finding patterns when they are not. For instance, we complete the incomplete patterns in our head and assume it will go as expected. For example, there will be an incomplete double bottom pattern that didn't really touch the last highest price point to be valid, but we're so desperate to make a trade, and we pull the trigger in anticipation. We should get used to the idea of imperfection, but forcefully finding patterns and neglecting everything that follows will get you in trouble in the long run. Number 10. Don't be completely blind to fundamentals. The entire video has been focused around technical analysis, but there's still value to fundamental analysis. It wouldn't be feasible to apply fundamental analysis to every trade, but it's important to be aware of some fundamentals. Understanding fundamentals can help you to measure the legitimacy of certain price action. For example, let's assume you see a stock breaking out 50% on the day. You may want to understand the legitimacy of the move before deciding whether it's a short or a long play. If the stock is breaking out because it doubled its earning estimate, maybe you may want to hold off the short position. Contrarily, if the stock is artificially breaking out, you may take another approach. It can be helpful to differentiate between legitimate and artificial price movement, even if your strategy is primarily technical. If you learned something new and found value, leave us a like to show support. Subscribe to our channel and click the bell icon to stay notified when we upload new videos. Until next time.